Thanks for joining us, everyone. My name is Jordan Ben-Shia. I'm the Executive Director of the VIN Foundation, and we are very excited to be collaborating with ACVIM on this small animal diplomats specialty webinar. This is our third webinar with ACVIM, and we're really excited for this collaboration. And we have Marianne and Michelle with us from ACVIM. And I'm just going to go over a couple housekeeping things for today. So if you are attending the session live, you do have the option to get CE, and that'll be in a follow-up email that we send after the webinar. This is being recorded today, so you will get a recording of this webinar along with Tony's Prezi links, which are kind of like the presentation and the slides that you can click through and hit all the links on your own, and additional helpful information. So those emails will be sent to everybody who registered. It'll go out tomorrow, and it'll be coming from studentdebt@vinfoundation.org. And then there'll be a link in there as well for you to get your CE certificate if you attended live. And that CE certificate will come from my email, jordan@vinfoundation.org. And we are really excited because a lot of the things that are great as part of this webinar is that you are able to do live Q&A. And that live Q&A we do with the Q&A button at the bottom. So we like to keep the chat for only technical questions going forward, but all questions, and we really, really encourage you to ask questions because you have a great resource here in Dr. Tony Bartels. And so use that Q&A window at the bottom of the screen and ask all of your questions there. There's also the option to upvote questions. So if you see a question and you think, wow, that's very similar to mine, go ahead and give that a thumbs up. And that'll let us know that multiple people are interested in that question and making sure that it gets answered sooner rather than later. We do try to get through all the questions. And once again, you've got an amazing resource here in Dr. Tony Bartels. So we really, really encourage you to ask questions. You can also ask anonymously. So we know that money can be an emotionally charged discussion. So there is that option there. And with no further ado, I'm going to go ahead and turn it over to Dr. Tony Bartels. Oh, let me also say we have Dr. Rebecca Mears here as part of our student debt education team, and her and I will be in the background helping with the Q&A. All right, Tony, take it away.
Great. Thank you, Jordan. Thanks, everybody at ACVIM, and thanks, Rebecca, for being here to help facilitate some of the questions as well. And so common themes. I'm a veterinarian. Dr. Mears is a veterinarian. I'm actually married to a small animal internal medicine specialist. She has student loans. We all have student loans. It's all very confusing, and I'm sure that's why you're here. But that's what we're going to try to do, is demystify as much of this as possible. And you guys, particularly as small animal internal medicine diplomats, have some really unique pathways that tend to generate a lot of more complicated student loan situations. And that's why I'm super excited to be partnering with ACVM on these sessions, is because it's been on my wish list for years to try to find folks like my wife, who had a very difficult time navigating all that advanced training and what to do with their student loans. And the system is necessarily not built very well to reflect that torturous pathway that you guys take to reach your specialty credentials. So here we are. We're finally kind of doing those things and being able to collect more information from you so we can run it through the knowledge database that we have on best practices for student loans and repayment options, which we've been building with VIN over more than a decade now. So we've got quite a bit of database on, good, bad, and ugly in terms of how to handle or how not to handle your student loan. So that's what you guys are going to receive here. And it's going to be geared towards that pathway that you guys take, and particularly those transition periods, right? So from when you graduate and you start that internship and go to that residency and then eventually finish that residency and you're board certified, all of those things have some very significant changes to your finances, not to mention your life, but to your finances that have very interesting consequences on your student loans, right? So it can be very confusing to know what to do, how to handle them at various aspects along the way, and then ultimately, what you should do with them long term. So hopefully we'll get all of those questions answered for you today. Again, please, because a lot of these are really specific to your circumstances. That's why I would highly encourage you to ask questions while you're here, right? So you do have that option to ask questions anonymously, or if you don't have to do it anonymously either, you can ask them in the chat and we'll do our best to answer those questions along the way. Don't feel like you have to wait until I get to the end. You can ask those questions as they come up. I did pepper in, for those of you that submitted some what I call the primary complaints for student loans in your Zoom registration. I peppered some of those questions in at various aspects, and we'll try to address those along the way. But we're going to dive right in, right? So with any complex case, it all starts with a good physical exam, and that's what we're going to do with our student loans, right? We're going to tap into that clinical training that you all have in terms of applying it to those complicated medical cases and redirect that effort towards our student loans, right? Because there's a lot of parallels, right? It really depends on what we're dealing with, what we find on those physical exams, which ultimately tells you what you should or should not be doing with your student loans now and going forward, right? And then when we layer on all of the recent changes and how they impact your repayment strategy long term, all of that tends to make a little bit more sense if we take that more clinical approach to analyzing our student loans. So just to let everybody know, I'm sure you're aware by now, painfully, that the pandemic forbearance benefits are over. The interest benefit ended at the end of August, so interest started back up. So you probably have seen your loan balances either creep up, or you've seen some interest accrue that was generated on the statement that you received for those payments that were due this month, right? So some of you, I think my wife's payment finally just triggered yesterday. So those first payment that we've made towards her loans in more than 3 years. My payment is still postponed until December because they made an absolute mess of my calculated payment under the new SAVE program, which we're going to talk a lot about, right? And that's why I have this check your loan servicers, right? I know you guys are crazy busy and have a ton going on, but you have to check in with what your loan servicer says, and I'll show you how you can check that against what your official Department of Education student aid data file says, because they're not always aligned. Right, particularly now when we just had nearly 4 years of no interest and no loans, and oh, by the way, we're changing a whole bunch of stuff and adding new repayment plans. A lot has changed, and the servicers unfortunately just haven't been able to get up to speed quickly enough, so they're making a lot of mistakes, right? And usually those mistakes are not in your favor, right? So if they are, then great, enjoy them, but the majority of the mistakes are not in your favor. Like in my case, my payment was much higher than it was supposed to be. So it took me a long time to get that corrected. So that will be reflected in my payment that will now be due in December. One of the common questions that came up, regardless of how you end up handling your student loans long-term, everybody receives forgiveness credit for that time that your loans were in repayment during that special pandemic forbearance period, which was, I think, 3.5 or 3 3/4 years long. You will get forgiveness credit for that forbearance time. And that's a question that people ask a lot. So we do have a differentiation between federal student loans and private student loans. Federal student loans, because of how the system is structured and because of how Congress has changed it over the years, you can see a variety of different loan types that are in that particular portfolio that you have. And I'll have some examples that will illustrate this. But the lion's share of your loans, depending on when you finish veterinary school, are probably in this direct loan category, right? So it's kind of the direct loan program, but there's multiple subtypes of loans underneath that program, right? So you may see unsubsidized loans, grad plus loans, or even subsidized loans from undergrad. Or depending on when you went to vet school, I had some subsidized loans from veterinary school, but they ended that ability for graduate school subsidized loans in 2012. Federal Family Education Loans, this was the predecessor to the direct loan program. So Federal Family Education Loans, or I call them FFELS, if you were in higher education and using student loans at any period in 2010 or before, you may see those loan types. And these are a problem, right? The newer repayment options and the benefits like public service loan forgiveness don't work well with these older FFEL program loans, right? So if you do have those, and it can be very confusing to know whether or not you do, you're going to want to correct that. And that's where we're going to talk about consolidation loan. And that's where we have some questions. And that's where a lot of the questions have been coming up, particularly recently, is do I need to consolidate, right? There's a lot of really good reasons to consolidate right now. And we'll talk about those later in the session as well. But knowing your loan types first will help to answer that question of whether or not it makes sense for you to consolidate. Because you don't want to consolidate if you don't have to, right? It takes time. And again, the loan servicers are screwing things up royally lately. So it's if you don't have to, you then don't, right? But if you can benefit from it, we'll talk about how you can approach that and make sure that you minimize those mistakes that they've been making. Perkins loans also no longer available, but I see them floating around still. Ironically, most of the Perkins loans I see in people's portfolios are paid off, right? And I don't know if it's just because it's a lower amount and people just figured, well, why don't I just pay the loan with the lower amount? But they can be consolidated, right? And included in a public service loan forgiveness or income-driven repayment strategy. So Perkins loans, health profession student loans, they are a type of federal student loan. They're infrequent, right? But if you do have them, you can consolidate. That's one of those reasons why you might consider consolidating, so you can have more of your balance eligible for these newer, more beneficial repayment plans and programs. Private loans are going to be anything that doesn't fall into that federal student loan category. Usually they have a bank name associated with them, right? So Wells Fargo or Bank of America, Sallie Mae, any of those, Discover is another big one, right? So private loans, they don't have these types of names associated with them. So they're going to have that bank name, your school name, or some organization that you borrowed that private loan through. If you've lost track of anything, it's always a good idea to check your credit report. You're able to do this at least once a year for free. They had been letting you do that once a week for free, particularly during the forbearance and pandemic periods. But I'm not sure if they're still doing that or not. I usually just trigger it when I'm filing my taxes, or if I have to provide updated income information for my loans that are in an income-driven repayment plan, I might check a credit report at that time of year too. So just get yourself into a habit of checking that credit report just to make sure that there's nothing on there that you don't recognize, right? So that's where you can identify those things and start to correct them if you have to. So what we're going to really focus on here is the federal student loans, right? Because they tend to be the more complicated. Private student loans, there's really not a lot of question or flexibility, right? You've got whatever you borrowed, you've got the interest rate and the amount of time that you agreed to pay it back, right? So you either have to refinance that private loan if you can get better terms, or you have to pay it under the terms that exist. Federal student loans are completely different, right? There's a buffet of repayment options and benefits that sometimes you're eligible for, other times you're not, and it really requires you to look at these loans more closely, particularly what types they are and when you started borrowing them, which will then open up all of the repayment options and benefits that you're eligible for. So in order to get that student aid file that shows or contains all of that information, we head over to studentaid.gov. All right, I'm going to walk you guys through this here. So if it's been a while since you've been in here, they've been making a lot of changes, but this is kind of the dashboard, if you will, for all things federal student loans. So I'm going to log in, and you guys will get to see my share of my student loan balance here. And this thing will send me a text message to my phone. Usually it's pretty quick about it. All right, there it is. 26873. Lots of scary language. But this is good, and they've actually made it a little bit easier for you to sanity check your loan servicers right in this dashboard kind of page, right? So it tells you a little bit of high level information. I've got my loans that my principal balance is about the same. My unpaid interest balance has changed because interest was turned back on September 1st, right? So I can see my loan servicer is Nelnet. My total amount due right now is 0 until December because of my payment woes, right? So they're giving me another couple of months while they figure that out. And then my next payment will be due on that 2nd of December. And I already know what that amount is. I'm not sure why it's not reflected in here yet. So you'll see differences like that as well. If you've applied for an income-driven plan, this is a newer portion that's really helpful, right? So people that have applied for a consolidation loan, or if you applied for an income-driven plan recently, all this activity will show up, right? This has been really really helpful, particularly as I was trying to correct my repayment issues, right? So you can see I have documented evidence of when I submitted my income-driven plan update to get them to recalculate my payment using the SAVE program, right? And I can see here, this was the last time I submitted my income documentation. It even shows that. It goes back pretty far, right? So this is that's probably been the bright shining star of the updates that have happened recently in this particular portal. But I'm going to come up here where I'm logged in. I'm going to go to dashboard. That'll take me back to that page I was on initially. And then I'm going to hit this view details link. This is going to take me to where I can download my student aid data file, right? So all of my higher education borrowing history will be contained in that particular file, right? So I can download that file as long as you're on a device that allows you to save files to that device. iPhones don't like that sort of thing, right? So if you're on a device that you can save a file, then save this TXT file, leave it in that same format, that TXT format, and I'll show you what you can do with that. That's where we're going to come over and head over to one of the tools that we're going to illustrate today that we use to do these federal student loan physical exams for our veterinary colleagues. And that's on the VIN Foundation Student Debt Center, particularly the My Student Loans tool, right? So we're going to upload that student aid data file that we just saved to our device to the My Student Loans tool. And I would encourage you to do this while we're talking about it, right? Because this is where you'll be able to ask those questions about what you're seeing in that particular file to help you navigate those questions that you have about your student loans. All right, so I'm guessing the majority of you have already graduated from veterinary school, unless there's some students in attendance here today. But I've got a few examples that I'm going to highlight for you. So I'm going to start with this one. This is a person who has finished their residency within the last couple of years, has had a significant increase to their income compared to their residency income, right? So which is probably quite common for those of you, particularly doing private practice. You're going to see that jump in your income right now, but graduating in 2017 and having nearly 6 years of, or more than 6 years of forgiveness qualifying credit, even though their income has jumped significantly, the question often is, do I continue to pay based on my income, or do I accelerate my loan payoff and not worry about my student loans because I'm unlikely to hit forgiveness? And that can be difficult to tell. And I can tell you that after we've already run this circumstance for this particular person, they posted their situation over on the VIN Foundation Student Debt Message Board area, which I'll show you guys as well to get that answers to those exact questions, right? But their debt or their income actually currently exceeds what their student debt balance is, but because they have 6 or 7 years of qualifying forgiveness time already, and they're using a plan that triggers forgiveness after 20 years, it's still quite likely that they're going to reach forgiveness, and it will be the lowest projected total repayment cost for them, right? So it's not a no-brainer that just because you finish your residency and you're no longer earning 40 grand a year, and even if your income, like in this case, is $225,000 a year or more based on production, it's not a no-brainer that you should just pay off your student loans as fast as you can. In most cases, because you guys have taken a little bit longer to get to that point, you're going to want to pace yourself on how much you pay towards your student loans, and really instead accelerate building that financial wellness plan, which is way more critical than accelerating your student loan repayment, right? So making sure you have a robust emergency fund, maxing out all of those tax advantage retirement savings because you've postponed that longer than most with your advanced training as well, right? So you're late to that for retirement savings game, and time is your friend there. So you want to save as much of that as possible in those available accounts so you can get that ball rolling, right? Your student loan repayment, whether you accelerate it or you reach forgiveness, is really not going to be that much different, right? So in that case, I'm going to peg my payment to my income. I'm going to pay what my income requires, and I'll either hit zero or I'll hit forgiveness, right? Either is going to be fine, and I prevent myself from just throwing all of my available disposable income towards my student loans and hoping that it makes a difference, right? So hope is generally not a strategy, right? So looking at the numbers, running them, understanding them is really a better way to approach this. So we're going to look and see what we find in this student aid data file, right? So we've got quite a few loans. I've got my principal, my unpaid interest, my weighted average interest rate, right? Another reason why I really don't want to accelerate my payment on this. I mean, I can almost get this on a savings account these days, right? So this is really quite kind of beneficial. So I mean, this is not any kind of dangerous debt that I really need to accelerate repayment of that. But I'm going to go through and look at my portfolio, see what I have remaining. In this case, all of my remaining loans are in that direct loan category. We can see here that they did have some of these older FEL program loans, right? But they've paid them off already, right? They're already gone. So we don't have to worry about them in this particular case, but this is what it would look like if you did have those loans and maybe had a balance on them. Right, so you'll see those in loan groups. If you want to know what types you have, here's that direct unsubsidized. Here's some subsidized loans. And then those FEL program loans were unsubsidized as well. Your servicer will be listed in here. But this is probably one of the most useful tabs that you'll find in here is the income-driven repayment eligibility. Right, so you can choose whatever plan you want, but the income-driven plans have specific eligibility requirements, right? So you first have to know which ones am I able to use. And this particular person is eligible for the old version of IBR, pay as you earn, which used to be the most beneficial plan, sometimes still is, but will also be phased out coming up shortly, right? So that's a whole loaded topic that we'll get into. This is the new repayment option, saving on a valuable education, otherwise known as SAVE. It was converted from what used to be called revised pay as you earn or REPAYE, right? So REPAYE no longer exists. SAVE has taken its place. If you were using REPAYE previously, like I was, it will automatically convert you to SAVE, maybe not correctly, right? But that's what will happen, right? The system will start putting you in SAVE. Theoretically, you should have a lower monthly payment, but that's theoretical, right? So we have to check that. Income-based repayment, the newer version, IBR 2014, this is an either or, right? You're either eligible for the old version or you're eligible for the new version. Right? So if your first loan was after July 1st of 2014, then you're eligible for the new version. Right? The new version looks a lot like pay as you earn. So the fact that pay as you earn is going to be phased out is not a big deal as long as you're eligible for the new version of IBR. Right? So that's one of those first things that I'm looking for because that opens up the repayment strategy possibilities and makes them even more flexible than if you're not. Right? So this person is not, which puts them in what I've been affectionately referring to as the pickle, right? Do I stick with pay as you earn? Do I switch to SAVE because my payment will be lower? We're going to talk about how you work your way out of the pickle during the course of the rest of the presentation here. If you're working towards public service loan forgiveness, I saw a lot of people ask questions about public service loan forgiveness. We did do one that was more specific towards public service loan forgiveness, but I know there's a lot of overlap. But if you have any public service loan forgiveness time officially logged in your file, you'll see it here, right? So if you upload your file, we've got a PSLF status where if you've submitted an employment certification form, you'll see the number of months that you have already logged. Right, so that's a good thing to keep track of, right? So some of you may have been able to get some public service loan forgiveness credit for your internship or residency time if they were at academic institutions, right? And if you didn't, you may want to think about applying for that time just in case, right? You never know where your career may take you. So if you end up in a nonprofit qualifying employment realm where public service loan forgiveness could be on your radar, then you want to get as much time logged as possible. We could see here too, and this is kind of a backdoor way of seeing your repayment plan that you're using, but this person is currently using pay as you earn, right? I'm going to come over to one of these other tabs that shows my loan information. I'm going to hit this show details button and I'll see the loans I'll see the repayment plan that my loans are in, right? So I see my repayment plan is pay as you earn. I have a very low monthly payment of $67 per month. Right, and that is good until May of next year, right? So May of 2024, right? So even though this person finished their residency a couple of years ago, because of the nature of the pandemic forbearance benefits, they last provided income information back when they were doing their residency. So their payment is very low and it will still stay that low, even though their income is significantly jumped, which is why forgiveness is still a possibility for this person. right? They're going to be 7, which is nearly halfway through repayment under pay as you earn without making any appreciable payments towards their student loans, right? So they've paid $13,000 total, and then most of that was from those undergrad loans, those FFEL program loans that were already paid off. Right, so they've made very little payments here. Now they're earning a specialist income, right? But they can still take advantage of these student loan repayment benefits to jumpstart their overall financial wellness. Right, so this is another one of those items you want to use to check your loan servicer, right? What are they telling you that you're supposed to pay for this October payment? Does it match what your file is showing? And if it doesn't, why? Right, so there's been a lot of loan servicers shifting. There's been, the new plans that have come online. They're automatically converting people from revised pay as you earn to the SAVE program, and that hasn't been going well mathematically, right? So knowing what those numbers can be, should be, and then checking what your loan servicer is telling you gives you that information to go back to them and say, hey, I don't think something's right here, right? And you're going to have to walk them through and help them correct it because they're just not very helpful. But there can be significant dollars on the table, right, for you to do that, right? So it's worth your time. When you upload your file here, you'll be able to send this information then over to the simulator, and we'll get there later, right? We'll talk about how to then answer that question. Should I accelerate my payment? Can I compare that versus continuing to pay based on my income? What do those look like? All right, so generally speaking, for your repayment options, you have 2 different categories, time-driven versus income-driven. And we've kind of alluded to this. Time-driven are kind of like those private loans, although you can pay your federal student loans back on a time-driven scale as well. They all work the same, right? So you're going to take your principal, interest, and the amount of time that you agree to pay it back, and that's going to generate a payment that you pay most likely the same payment each month until you extinguish that balance over that specified period of time, right? So a standard 10-year plan, that's kind of the default plan that they put your loans into if you don't choose something else, but that's a plan that's designed to extinguish your balance in 10 years or 120 monthly payments. The problem with the time-driven plans is they don't care what your income is, right? So they don't work very well, right? Like when you were doing your internship or residency, you can't really use a 10-year plan on a $220,000 balance because you're not even earning enough to cover that monthly payment, right? So that's where we can't use those time-driven plans necessarily during our advanced training, which leads us into those income-driven plans, right? So again, you have these very beneficial options for your federal student loans that you don't have with other types of debt, right? You're never going to have a mortgage or an auto loan or a practice loan or an equipment loan that's going to let you pay based on your income. Right, that's unique to those federal student loans that you have. And here's just some illustration on, yes, I may want to pay that balance back quickly, but we have to be realistic too, depending on what that balance is, on what that minimum monthly payment would be, right? And just because you can maybe cover that payment doesn't mean you should, right? You want to compare that against what your income-driven plans require you to pay. And if there's a significant enough difference there, then take that opportunity to use that additional cash flow to fund other more beneficial areas of your overall financial wellness, right? That's where that additional cash flow can come from. Okay, so these income-driven plans, again, they're only eligible for your federal student loans. This is what it used to look like, right? And now it's going to, or it already has changed, right? So revised pay as you earn turned into SAVE. SAVE will have the lowest monthly payment of any of the available income-driven plans. Now, it may not right now because, like I illustrated in that example of the person who's using pay as you earn, they have a very low payment because they haven't had to provide income documentation in 3 years. And in that 3 years, they finished their residency and started getting paid as a specialist. Right, so even if they did switch to SAVE, they would increase their payment right now, right? Because you'd have to provide income information again. So in those cases, you want to keep that lower payment for as long as you can, and then we're going to think about whether or not it makes sense for us to switch to SAVE at that point or continue on in the repayment plan that we're currently using. So pay as you earn, the income-based repayment, you're either eligible for the old version or the new version. They're going to phase out pay as you earn and the income contingent repayment plan, but the income contingent repayment plan was really not very beneficial for anyone except very, very specific cases that I almost never see. But they're going to phase these out, which means if you're using them, you're eligible for and using them now, and after July 1st, you can keep using them. But if you're not using them, after July 1st, even if you're eligible for it, you're not going to be able to choose it as a repayment option. Right. So that contributes to what I've been calling that pickle, right? Should I get my loans into pay as you earn before it's phased out? If I'm in pay as you earn now, should I keep my loans in pay as you earn, or does it make sense for me to switch? Right. And we can answer those questions based on our physical exam and then eventually running those simulations to see numerically which one makes the most sense. For those of you that are eligible for the new version of IBR, there's a very unique opportunity for you to use SAVE and then switch to the new version of IBR so you can receive forgiveness sooner. Right, and this is going to work extremely well. So if for any of you that are mentors or coordinate or run residency programs, this is a huge improvement. Right, so for those people who are eligible for new IBR, you can use SAVE while you're doing that training and then switch to the new version of IBR after you complete the training, and you'll receive the low, in many cases, you'll produce the lowest possible payment outcome and be in repayment for the shortest period of time, except for maybe something like public service loan forgiveness, right? So there's this new switching opportunity between SAVE and the new version of IBR is really going to be helpful for those of you in that advanced education realm and specialty realm. Another reality that has come out of the updates recently is that the old version of IBR is now obsolete. Right, so if you find yourself using or you've been using the old version of IBR, then you want to get out of that and into SAVE. Right, SAVE is going to be better than the old version of IBR every day of the week. Right, now the only exception is to that is kind of like in our example, where if you have a very low payment under IBR 2009 because it was based on your internship or residency income back when you last renewed your income, keep that until you're next due to renew, but then you want to switch to SAVE. Right, so there's not going to be a very good reason for anybody to use the old version of IBR after that next renewal for any reason. Right, SAVE is going to be a better repayment option than IBR 2009, which is great because while that was a good start in the income-driven repayment universe, the newer plans are much better. Right, and it'll keep your costs down and keep your loan balance from growing. Oh, so where's public service loan forgiveness? I do this to point out this confusion where, people often tell me, well, I'm in public service loan forgiveness. It's like, well, you're not really it's not a repayment plan, right? You use one of these repayment plans, which is a requirement of public service loan forgiveness, is using one of these income-driven repayment options. And you can earn public service loan forgiveness if you satisfy all of the other requirements, the employment requirements, right? And making sure that you're using one of these income-driven plans. Right, so public service loan forgiveness falls more into that benefit category than an actual repayment option. All right, so how do they calculate your payment? This is how you can math check your loan servicers, and everybody needs to be doing this right now, right? Because they've been screwing things up left and right. So you're going to take your income, ideally your taxable income, which I would use your recent adjusted gross income, right? So pull up that tax return that you filed for 2022, right? So that's the most recent tax return that everybody most likely has on file. Look at that adjusted gross income. Right, there's an adjusted gross income line item right on that tax return. They will always accept that, the AGI from your most recent tax return. Right, so like in the case of our person who just recently finished their residency, right, their recent AGI might be a blend of their last year of residency and their first year of specialty practice, right? So their AGI is going to be significantly lower than what their AGI is going to be for maybe this tax year. Right, and if that's the case, then you want to use that prior AGI as your income for calculating your monthly payment. Right, so that's how you can use, and this is one of the questions that somebody posted here, reporting my adjusted gross income versus salary and when to start in repayment. So it depends. It depends on how your recent adjusted gross income compares to what your current salary is. Now, if your current salary is lower, then don't use that prior AGI. You could use your current salary income information instead. Right, so think of the AGI as the gold standard. No matter what it says, they will always accept that most recent adjusted gross income. Right, so that's where, this is where you can give yourself some time if you're thinking ahead, if you haven't completed your residency, or maybe you just did, and you're going to have one of those blended years where half of your year's income is from your residency, the next half is from your specialty income. When you file your tax return this year and you use that for your next renewal, for your income-driven plan, your payment will still be lower than your current income shows. All right, and that's how you can use these plans strategically to keep your payments low. And if you're using a plan like SAVE, right, you won't see any consequences to your student loans, right? And that's what opens that door for you to use that additional income to jumpstart those other areas of your financial wellness instead of focusing on your student loans when you don't really have to. So they're going to take your taxable income, they're going to subtract off an allowance, right? Essential living expenses kind of bucket, right? And depending on the plan you choose will depend on the allowance they give you. Right? So this is what makes SAVE the most beneficial, right? 10%, and they're going to use this 225% of the federal poverty guidelines. So my adjusted gross income minus 225% of the federal poverty guidelines, which you can look up online. Right, and we're going to take 10% of that as our payment. Right, so let's use an income of 175,000. We're going to subtract off 225%. This is the federal poverty threshold for a family size of 1 in the lower 48 states. My discretionary income for SAVE is 142,000. My discretionary income for PAYE, or the new version of IBR, is 153,000. Right, so that's what generates the differences in those payments. Right, so SAVE at 175 grand a year requires me to pay 1185 towards my student loans, right? When that is the income documentation that I use. Right, for Pay As You Earn, it'll be slightly higher. This is why nobody should stick around in this old version of IBR, right? Those payments are significantly higher based on that discretionary income formula. If you guys want, and Dr. Morello has been publishing a lot of great information. That's where the 175 comes from. Now, this data is now a little bit dated. I was super excited when it came out, but she's been doing a great job studying and tracking and publishing a lot of the incomes in certain specialties, right? So this is the most recent one I'm aware of, but this is where I'd like to see more work done by the specialty colleges in general, is reporting on the incomes more regularly, right? So we have a better idea of what are small animal internal medicine diplomats earning in academia versus private practice, and how does it break down among the different specialties, right? That would be really helpful information, right? And up until Dr. Morello started publishing some of this, there was none, right? It was really just kind of word of mouth. So that's nice that there is some of that information. So you guys can look that up if you want to see how some of that pans out for different specialties. All right, and this gives you an idea of what those payments would be under various income levels for a family size of 1, right? So generally speaking, the higher your family size, the lower the monthly payment, right? But we're gonna just pick a family size of 1 for the time being, just for the ease of illustration. But this also gives you an idea, if you were planning to pay, $2,000 a month towards your student loans, well, then your taxable income needs to be at least $270,000. If it's not, then don't pay $2,000 a month towards your student loans, right? It's not time for you to do that, right? So use your income, let your income determine the monthly payment, and then you can prevent yourself from throwing more money than you have to towards your student loans, and it gives you more opportunity to work on some of those other areas. I did see a lot of comments about having more affordable monthly payments. I mean, this is the answer. Right, as confusing as it is, and as complex, and and as difficult as the loan servicers make it, this is how you achieve this, right? This is how you make sure that you're not paying more than you have to towards your student loans, or it takes that guesswork out of the equation, right? I don't have to figure out, do I pay $3,000 this month or $2,000 this month, or which loan do I pay towards? And all of that, if you throw it out the window, right? Just use your income, sets the minimum monthly payment, it gets applied across all of your loans. Just another reminder that old version of IBR is going to be obsolete. All right, so this is where, we can look at that current kind of the short term, right? So how do we, treat the immediate, right? But then we have to look beyond that as well, right? So we have to see, okay, if I keep making payments based on my income, am I going to hit forgiveness? Will I pay the balance to zero? Which one makes more sense, right? So that's where we run simulations using the VIN Foundation Student Loan Repayment Simulator. We plug in our specifics as part of those simulations, and the math, we do the math and the simulation for you, and then you can compare the outputs, right? Then you can look to see, does it make sense for me to continue making payments based on my income, or is there some other alternative that might be more beneficial for me, right? Because the reality is, if you make payments for a given number of years and you reach that maximum repayment period, so pay as you earn 20 years, the new version of IBR, 20 years, save 25 years. If you hit that magic number and you still have a balance remaining, that's what triggers forgiveness, right? Whatever principal unpaid interest you have will be canceled, i.e. forgiven, right? And then you'll pay tax, maybe, on that remaining amount, right? Generally speaking, canceled debt is treated as taxable income. However, there is a tax exemption in place for student debt that is canceled in any of the tax years between 2021 and 2025. Right now, none of you are likely to receive forgiveness between 2021 and 2025, but it has opened the door for that possibility of student loan forgiveness being tax exempt in the future. Right, so we'll have to see what Congress decides to do beyond 2025. Now, there's a lot of people that think that they're going to extend that tax exemption. I don't put my finger on one side or the other on that one. If they do, that would be wonderful. If they don't, then it was like it was before, right? But in either scenario, I'm going to plan, if I'm projected to hit forgiveness, as if I'm going to have to pay a tax unless I know I'm in one of these tax exempt windows. Right, it's always easier to make adjustments and plan for that tax than it is to just cross your fingers and, again, hope that you don't have to pay one, right? Hope is not a strategy. There's been people on the message boards that have kind of thrown their hands up in the air and said, I'm not even gonna worry about it. I'm sick of worried about my student loans. I don't want to have to worry about saving for the tax. I'm gonna roll the dice. That's not a strategy that I would be able to sleep well at night with. Right, so the sooner that you can get started saving for that tax, the more flexibility you have, and you'll see that reflected too in a lot of those student debt discussions. The people that have started saving for forgiveness have way more options when it comes to considering a switch, or what if I switch gears in terms of my career strategies? They just have way more flexibility if they have started that forgiveness savings plan dedicated to covering that tax sooner rather than later. Now, I certainly don't expect any of you to start saving for that tax while you're doing internship and residency training, but that's another one of those things that if you know that you're likely to hit forgiveness and maybe have to pay a tax, that's one of those line items you want to add in your post-training budget, right? Where you're earning more, you've got more income coming in, you want to dedicate or appoint some of that income towards something like a forgiveness tax down the road if you're projected to hit forgiveness. And is it a tax, or is it a penalty or a discount, right? So a lot of people call it the tax bomb, which tends to have some negative connotations around it. In reality, if you're going to hit forgiveness, it ends up being a huge discount on your student loans, right? So the top marginal tax bracket in this country at the federal level is 37%. So the worst case scenario, which is not a worst case scenario because it means you're earning a lot of money, is you pay 37%, right? So if you had $200,000 and you had to pay 37% on that tax, on that remainder, right? So you're getting a 63% discount on that $200,000, right? So it ends up being a pretty significant discount on your remaining balance. You just have to pay it all at once towards the end there, right? So instead of making large payments along the way, you make very, very small payments until you hit forgiveness, and then you pay a discounted remainder of what's left at the end. And we can
Tony,
see
a
how
question.
that. Yeah, go ahead.
Sorry, I was gonna say question in the chat here. So does that mean the people who are hitting 25 years and 21 to 25 aren't taxed on the remaining principal? That's why it likely won't apply to us.
Yeah. That's a very loaded question, but it's a very simplistic example. So anybody that would hit forgiveness, let's say this year, in the 2023 tax year, would not have to pay tax on it, right? Because of this tax exemption, right? So same for 2024, 2025, right? If you reach the 20 or 25 year maximum, or because you received the one-time forgiveness count, which we'll talk about, that's one of the benefits that's currently still in place. That's giving a lot of people a lot more years in repayment than they ever thought they would have. And those payments are being credited towards forgiveness. That's where this tax exemption is really helping. Right. So let's say, and this may apply to some of you, and we're kind of jumping the gun in terms of this one-time forgiveness count adjustment, but we'll get there. But just to illustrate this, let's say that you had some loans from undergrad that were in the early 2000s, and you made some payments on those loans, and it was some time between then and when you started vet school, and you borrowed for vet school, and then you had your loans, in some kind of repayment plan during your internships and residency training. You theoretically could have 10, 15, approaching 20 years of forgiveness credit on the oldest loan in your portfolio, right? And if that's the case, then we're going to encourage you to consolidate your loan so you can get the new consolidation loan will reflect that highest repayment count total in the one-time forgiveness count adjustment, which makes you closer to forgiveness, maybe even gets you into this tax exempt window, right? But either way, your loans are gone sooner rather than later. And generally speaking, the sooner they're gone, the less you're going to pay. Right. And oh, by the way, people tend to want to see their loans gone sooner rather than later. Right. So if you can take 20 years, great. If it requires 25 because of the plans that you're eligible for, like myself and my wife's situation, so be it. Right. So in some cases, too, the 25-year pans out even less expensive than the 20-year. Right. It just depends on the specifics of your circumstance. But yes, if you receive forgiveness for any reason, on your student loans specifically, in any of these tax years, you won't have to pay a tax. Right. Now, what happens in 2026 remains to be seen. So we don't know yet. This was somebody posted this. I just want to make sure we clear up this. There is no 30-year forgiveness. Right. Nobody's in repayment on their loans for 30 years. That's one of the things that one-time forgiveness count adjustment is trying to fix. Right. Is that if you've been in repayment, and because of all the changes and because all the mistakes the loan servicers make, and maybe you've had loans that you took out 30 years ago, right? That shouldn't have happened, right? You shouldn't have been in repayment for that long. So they're going to give you forgiveness credit even if you weren't using an income-driven plan, right? So we can eliminate that possibility of people staying in repayment forever. Right, so the worst case scenario is that you're in repayment for 20 or 25 years, depending on the repayment option that you're using. Right, and you'll either pay the balance to zero before that time frame, or you'll hit that maximum repayment period and you'll trigger forgiveness of your student loans. And whether or not you're taxed on that will depend on the tax exemption that's in place at that time.
Can you also comment on, there was a question here about forbearance credit and time during the pandemic, forbearance counting towards that forgiveness time?
Yeah, so we talked about it earlier in maybe you were a little late to joining that, but yes, the forbearance time that there was no payments and no interest accruing, everybody gets forgiveness credit for, right? So that is forgiveness eligible time, right? Now, if you were in a repayment plan, for sure, right? Now, if you were, there's some other statuses that your loans can be in, as long as you weren't in school during that time, then that will automatically be counted towards forgiveness under the one-time forgiveness count adjustment. Right. So it's not automatic that forbearance, that pandemic forbearance time would have been credited towards your forgiveness clock, but the one-time forgiveness count adjustment pretty much makes it guaranteed that it will, as long as you weren't in school during that time. So that's the only exception to that count adjustment, as in-school time doesn't count as repayment time. All right, so public service loan forgiveness, just a kind of a brief overview again, because a lot of people had questions about it, and there's a lot of overlap in your guys' universe in terms of public service loan forgiveness eligibility and career options. So it's related to, but very different from income-driven repayment plan forgiveness. Right, so here are the requirements in order to be making a public service loan forgiveness eligible payment. Right, there has to be direct loans. Right, so this is why we do that physical exam of your student loans, or one of the reasons. We want to make sure that all of the loans that are remaining are in that direct loan category, right? Because only direct loans are eligible for public service loan forgiveness. These are the repayment options that you can use to satisfy the requirements. A standard 10-year, which doesn't make any sense if you think about what you're trying to achieve, or an income-driven plan, right? So an income-driven plan payment is what you're going to want to use, ideally save, because it's going to trigger the most or the lowest monthly payment. You have to work at least an average of 30 hours per week with a nonprofit. And you have to do that for 120 monthly qualifying payments or 10 years. It doesn't have to be consecutive, right? But you still have to hit 120 monthly eligible payments. 30 hours per week with nonprofits. So all academic residencies are nonprofits. It's just a matter of whether or not that program considers you an employee, or if they think that you meet these thresholds. I personally believe that every residency at an academic institution should be public service loan forgiveness eligible, but it really is at the discretion of the person who signs that paperwork. Right? So there's a public service loan forgiveness employment certification form that you complete. Your employer completes a portion of that, and they have to acknowledge that you meet this definition. Right. So sometimes they're willing to, sometimes not. Right. So just because it was denied once, I would not give up on it. Right. Because again, I think that those residency programs meet the spirit of those public service loan forgiveness rules. You just have to find the person there that will be willing to sign off on that. If you have loans that aren't direct loans, then consolidate them. Right. So if you've got those health profession student loans, Perkins loans, those older Pell program loans, consolidate your loans. Right. That'll make them a direct loan. All of them will be eligible for SAVE. All of them will be eligible for public service loan forgiveness. And making sure it goes through, the only thing that you really need to do is make sure you're checking all these boxes, right? But then submitting this public service loan forgiveness employment certification form, right? So that's going to determine or show you what that count is of loan payments that you have. Right, so you want to make sure that you have that feedback mechanism with the Department of Education, where you can see that they know that you're on track to reach public service loan forgiveness. So when you reach those 120 monthly payments, all you have to do is say, look, you've already got my, 110 monthly payments. I've got 10 more to add. It's time for you to give me public service loan forgiveness, forgive my loans tax-free, right? There is no tax associated with public service loan forgiveness ever, regardless of the tax exemption status. It's written into the law that established public service loan forgiveness. If you receive public service loan forgiveness, you will not have to pay a tax. So it is the holy grail of student loan repayment. If you're trying to get your loans extinguished quickly and not pay very much towards them. And also, you never know where your career may take you, right? So some of the more tortuous ones that we see on the message boards are people that were making aggressive payments towards their student loans, and a few years later, they find this magical career opportunity at a nonprofit, and they jump all over it, and then they want to know about public service loan forgiveness, and they can't go back in time and claw back those payments that they made above what they were required to make, so they could have more of it forgiven. Right? So there's really not a lot of incentive or good reason for you to accelerate your payment beyond what your income requires. Right? It's kind of an insurance program against making sure you don't miss out on any of these things like public service loan forgiveness or end up paying more than you have to towards your student loans.
Before we move on from, go ahead. I was going to say, before we move on from PSLF, there are a couple of questions in the Q&A that are related here. Yep. Should we consolidate still if we don't apply for or are not eligible for PSLF?
Oh, well, it depends. That's a
Mhm.
hold that question until we get to the consolidation slide, because it depends on what loans you're seeing in there that you're asking about, and also depends upon whether or not you're likely to reach forgiveness. Right. So, in my opinion, if you have non-direct loans in your portfolio right now, and you're likely to hit forgiveness, whether it's public service loan forgiveness or income-driven repayment forgiveness, then consolidate. Right, because there's never been a better time to consolidate. You still preserve all the forgiveness time that you currently have. If you've got public service loan forgiveness time and you consolidate loans, you'll still preserve that public service loan forgiveness time. You'll even transfer that over to those loans that weren't otherwise eligible. If you have any reason to consolidate, now is the time to do it, now and before the end of this year. Right, so public service loan forgiveness is one of those reasons. Right, if you have public service loan forgiveness time, you see yourself potentially working for a nonprofit in the future, or you otherwise have non-direct loans, then consolidation can be a great idea. Right, now, if you've got 99% of your loans are direct loans and 1% is not, then maybe it might not make sense for you to consolidate. Right, so it really depends on the specifics. But in general, for public service loan forgiveness to make more of your loans eligible, yes, absolutely. Right, but there's also other reasons why you'd want to consider consolidation before the end of this year as well.
Another one here about, can you speak to whether someone in pay going for PSLF should switch to save?
Yeah, that's also a kind of, it depends. It depends on how much time you have left before you reach public service loan forgiveness, right? That one falls into that bucket of what is your minimum monthly payment now, right? There's been a number of people who are knocking on the door of public service loan forgiveness, meaning they have a year or two of payments left, right? Or maybe, but they have a very beneficial pay-as-you-earn payment right now, like this person that we were looking at here, right? So if this person wasn't due to renew again and would receive public service loan forgiveness before they're next due to renew, then they can keep their loans and pay as you earn, right? Because the payment is lower than they can otherwise get under save, right? But if you've got a couple of years left of qualifying payments to make and you're going to have to renew your income again in the future, then your payment is going to be otherwise lower than it would be using pay as you earn if you switch to save. Right? So switching to save in that case would make sense. Right? So it depends on when you're looking at when am I due to hit forgiveness, when am I due to renew, and what are my monthly payments going to be going forward, right? Pick the one that has the lowest monthly payment when you're working towards public service loan forgiveness, because you want to have the maximum amount forgiven, tax-free, and pay as little as you have to. Right? So that might mean and probably means switching away from pay. It's just a matter of when. Right? Am I switching after my anniversary date? In this case, yes, right? If I was working towards public service loan forgiveness. If I'm going to hit public service loan forgiveness before I'm next due to renew, then I don't need to worry about switching.
Another one here for those with a previous time that wasn't logged. If we are working in a nonprofit government but did not fill out the employment certification form in previous years, are those years lost towards PSLF?
No, they're never lost. You can go back and get that qualifying time, especially if it's a government entity. It's going to be easier for you to find somebody there that can acknowledge that employment time, right? And you could even try the electronic. There's an electronic portal. Oftentimes, if they find your employer in that portal, you can do that without even having to go back and ask somebody there to sign off. They'll find your employment in the system. But that can be complicating. Let's say you're working for a nonprofit entity that closes its doors and you didn't get that time certified. That might be more difficult, right? So that's where, while you're working for a qualifying entity, get that time certified, right? Get it logged. Again, you never know where your career may take you, and it can be difficult later, especially if you find yourself years removed from those particular experiences. The people that you used to work with there may not remember you or can find you in their system, right? So it's always easier or better to submit those employment certification forms while you're there or right before you leave.
Can you just switch back to the My Student Loans tool real quick and show that anniversary date and where to find that once again? Thank you.
Yep. Yeah, so when you upload your file, whether you're on the loan groups, loan types, or loan servicers tab, if you hit the show details button, there'll be an anniversary date column. And if you're using an income-driven plan, 95% of the time, you'll have an anniversary date listed here, right? So now that anniversary date, and this is kind of jumping ahead too, might show a date in the past. Nobody has been required to provide updated income information during the forbearance period and 6 months after it ended, right? So if your anniversary date doesn't show something that's beyond March of 2024, then you need to add a year to it until you do get beyond March of 2024, right? That's the next time anybody is required to renew their income information. But the anniversary date is going to be dependent upon when you've been providing income information in the past. It's not the same for everybody. It's different for everyone. So look and see what that anniversary date is. Check that against what your servicer is showing, right? And then you can do that math in your head again. Can I get a lower monthly payment than I have right now based on the income information I have? Then I can provide income information. Right. So when I say you're not required to provide any income information, if your income is decreased for any reason, then you can. Right. We see that. I actually see that happen a lot more frequently now in the advanced education realm than I used to before, because you have these situations where people are doing private practice internships that actually pay quite well comparatively. Right. And then you get an academic residency and your income drops. Right. Because the academic residency income is lower than the private practice internship income. Right. So in those situations, you would have cause to provide updated income information because you're earning less, right? You don't have to wait until that anniversary date if your income has decreased. Is there a way to see that anniversary date on the studentaid.gov without uploading a file? Well, if you do, great. But it may not be there, right? I would, hopefully this would reflect what that is showing. But if you could also tell me why you don't want to upload it to the VIN Foundation My Student Loans tool, I'd love to know that. But yeah, we're pulling that information out of that file, which is the same information that the student aid site uses. It just sometimes it depends on what they show you, right? So we built the My Student Loans tool because this is the information we found to be relevant in terms of making informed decisions. So if you want to look through the file, you can look through the file yourself too if you want to pick through it to see it. But if you upload it here, you'll be able to see it more easily. And if you want, you can ask questions about it, right? So I haven't yet gone over to the student debt message board area, but when you're logged in and you upload your student aid file, right, you have access to the student debt message board area. If you have a VIN username and password, it'll take you to the special student debt message board area where Dr. Mears and I have been crazy busy lately. There are thousands of discussions in here, right? So this is where all of this information comes from, is helping our colleagues work through their student loan repayment strategies. And and if you have questions about what you're seeing in that My Student Loans tool, that's why we have these message board area, right? For you to post that information and questions so you get the answers that you need, but our colleagues get to learn from those experiences as well, right? And you'll see in this special student debt area that you're allowed to post anonymously, right? Because there's a lot of sensitive financial information in here. You can do that, have that conversation anonymously. Rebecca and I will know who you are, but the rest of the VIN community does not, right? So, but this is where we go through and kind of help you navigate all of those different questions that come up when you're looking at your student loans. All righty. I wanted to just show you guys that public service loan forgiveness is a thing, right? So I know a lot of people that got a lot of really bad press when the first round of folks were eligible and were getting denied. But this is a veterinarian who had more than $430,000 forgiven tax-free, right? They were denied first, but then there was this temporary expanded public service loan forgiveness benefit that was added on later that she was able to go back and apply again and then had her loans forgiven, right? So this is happening not only for veterinarians, but for thousands, hundreds of thousands of people who have had their loans forgiven under public service loan forgiveness, even though they may have been denied initially. So this is working. It's still confusing, but it is working. All right, so I'm going to show you guys how I handle my student loans, and I wanted to give you kind of that baseline of understanding. just so you can, the terminology, and we're all kind of on the same page, right? So this relates to one of the questions I see in the Q&A panel about being married, right? So I'm married to a veterinarian. She has more student debt than I do. She's a small animal internist here in Denver, practicing along the Front Range where we live. But combined, we have more than $400,000 in student debt, right? So, and we have kind of gone through the ringer of all of the available options and changes, and the standard 10-year we couldn't use because it was more than we were earning. We started out with the old version of IBR, but then revised pay-as-you-earn came online, got our payment down even lower. Then we had the pandemic forbearance benefits, stopped interest, stopped payments, but still gave us credit towards forgiveness. And now we're both in the new SAVE plan, right? And this is really also to illustrate that at every step along the way, the options have improved. They've been confusing, and in some cases, they've been fraught with a lot of errors in order to get them to do what they say they're supposed to do. But the overwhelming trend has been to improve them rather than to make them worse from a numerical standpoint. Right? You still have to fight with the loan servicers, but from a numerical standpoint, it's worth it because we're talking about tens, if not hundreds of thousands of dollars of payment cost differences, right? So it's kind of worth it to, like the DMV sucks every time you go in there, right? But I like driving, right? I like the freedom it provides. So I'm gonna suck it up and do it because what's the alternative? So that's kind of how your student loans are behaving right now too. But hopefully we'll get past this initial pain point of this change, this switch, the end of the forbearance benefits, and get back to something that resembles normal like we were before, where it was, infrequent loan servicer annoyances as opposed to constant, right? So again, the trend has generally been to make these plans more beneficial rather than less, which does also make you wonder what's next, right? So again, then one of the reasons why I don't choose to pay more towards our student loans, even though we probably could, because we're still projected to reach forgiveness. We're nearly to our forgiveness goal with about 14 years before we reach it. And we're using a dedicated forgiveness savings plan to further reduce the amount that we would pay in that tax, right? So this is a snapshot of my forgiveness fund for our loans. The dotted line represents how much we've saved, put in there essentially, including the dividends from this combination of investments. And then the solid line is the value of that fund. Right, so the bigger this gap is between this dotted line and the solid line means the less I'm using of our own money to pay for the tax, which further reduces our total loan repayment costs. Right, I still have to wait until we reach forgiveness to trigger forgiveness so we can use this or maybe not use this if there's no tax due. But that's what our forgiveness savings plan looks like. And this is a platform called Wealthfront. If you're, it's a robo-advisor. There's dozens of those out there. It just happens to be the one that I like. But if you're comfortable doing this on your own, then you can use those robo-advising platforms, or you can seek out the assistance of a certified financial planner that can help you build something similar. So thought experiment, and this comes up all the time, right? So people that try to find a way to pay the interest on their loans each month, even though it's above what the minimum requires, or because they want to reduce the tax, right? It comes back down to that tax bomb concept, right? I don't want to have to worry about this tax at the end, right? And people do lots of weird things in order to reduce the tax. However, the tax, as we discussed, is a huge discount, right? So why don't I take, let's say if I've got $400,000 of student loans, and to keep the math simple, let's say I've got $100,000 in this forgiveness savings fund. Why don't I just cash that out, reduce our balance to $300,000, and say, hooray, I've reduced my student loans. All right, why is it a bad idea? If you have got any thoughts about this, throw it in the chat. See if you have any ideas why it might not be a good idea to either pay more than the minimum or try to reduce the tax at the end if you're projected to reach it. Let's just give it another second or two here. Loans could be canceled. Yeah, I mean, that's one reason. I mean, sure. I mean, and that it kind of gets back to that comment I made earlier where, maybe whatever the next repayment plan is, it'll be even more beneficial than save. And that's a valid reason to do that as well. But it's also because it's not going to help our financial circumstances, right? If I reduce my loans by $100,000 and I have $300,000 of student loan balance in 14 years before I hit forgiveness, we're still going to hit forgiveness, which means I have to start saving for the tax all over again, right? So I just voluntarily paid $100,000 more towards my student loans than I had to. So when I'm projected to reach forgiveness, it's much better to just pay what's required, the minimum monthly payment that's required, not a dollar more, right? And then plan for that potential tax down the road. Right. So that's really financially, that's what's going to work out best in the long run for you. It did go from 25 to 20 years. 25 to 20 years. It didn't, right? So the plan that we were using before was the original version of IBR, which had a 25-year maximum. SAVE also has a 25-year maximum. Right. The only ones that have a 20-year maximum repayment period are pay as you earn in the new version of IBR. Neither of those plans my wife and I were eligible for. Right. So that's one of the important reasons to do this. Right. Now, the pickle is whether or not you're going to give up a 20-year forgiveness plan in favor of a 25-year forgiveness plan because the payment is lower and the total cost might be lower. Right, we're starting to see that regularly. When we put the SAVE plan, I initially thought when we put SAVE into the simulator that anybody who was using pay as you earn would just automatically keep it, right? But SAVE is that much more beneficial for some people that it can justify switching away from a 20-year plan and going to a 25-year plan. But the trick or the pickle, the trick is there that you're voluntarily agreeing to be in repayment for 5 years longer. And for most people, that's a tough pill to swallow, even if the numbers show that it's going to be a lower projected cost. Right? So run those numbers and see if it's a no-brainer for you or you have reservations on that. But now is the time to figure that out, right? Because now you still have that luxury of choosing between pay as you earn and save in that pickle scenario. Here, let me upload one that actually reflects that. Right, and some of you may have seen this if you uploaded your file during this session, right? But this other example that I have is somebody who's not eligible for the new version of IBR. Right, so that is this person actually, I believe. Nope, that's actually the one I was looking at. Let me go back. Nope, that must be the newer one. Yes, this is the one that I was just about to upload. So this is somebody who's just starting their residency, right? And they posted their situation to the message boards. They graduated in 2021. They hadn't really chosen a plan yet because they didn't have to, because they were in the pandemic forbearance benefit period. But this person's eligible for the new version of IBR, which means they shouldn't use PAYE. They should use SAVE for reasons we'll talk about in just a few minutes. Will prevent any of their unpaid interest from accruing during their residency, and then they'll have the option of switching to the new version of IBR, right? That's the benefit of having that new version of IBR available to you. But if you're in this particular situation where you don't have the new version of IBR and SAVE would be numerically better for you, if you switch from PAYE to SAVE, you're going to lose access to pay as you earn after July 1st of 2014, which means you just added additional 5 years onto your loan repayment schedule, as long as you're cool with that. For some people don't mind being in repayment longer. Other people, it drives them crazy, right? So it's a tough one, right? That one is a hard one. We can show you the numbers, but it doesn't mean there's automatically an answer that's easy there, right? Because there's more of a mental component of, wow, the numbers show me that SAVE is going to be better, but I really don't want to be in repayment for another 5 years. Okay, so here's some of the changes we want to dive into a little bit in more detail. So there were a lot of questions about the new SAVE plan in your in your registrations. So here's the details for SAVE. So the monthly payments are going to be lowest, 10% in most cases of discretionary income. It might be a little bit lower depending on what your proportion of undergraduate student loan balance might be. But veterinary school is graduate school loan, and anybody with all graduate school loans would be paying 10% of their discretionary income. Almost all veterinarians are closer to the 100% of graduate school loan balances in their portfolio. 225% of the federal poverty guidelines, so the payment will be otherwise lower. There's an unpaid interest subsidy that comes with SAVE. What does that mean? It means if your payment, like in our example, is $67 a month, right? So they're accruing $922 a month of interest, right? So they're falling short on their monthly interest each payment, right? There's no consequences to that on your credit report or anything, but you're accruing an unpaid interest balance. That's how you get an unpaid interest balance. Right? So here's the temptation is people, when they have additional money, is they want to pay above this 67 and cover this. Right now, if you're using a plan like SAVE, the government will cover the difference between this interest and that monthly payment, which means you're receiving about an $875 per month subsidy. They're physically making a payment to your loan so that unpaid interest balance no longer grows. That is an awesome benefit, particularly while you're doing residency training or otherwise have a very low payment. Right, so that unpaid interest subsidy is a huge benefit that comes with SAVE. And again, here's more drama to quote the pickle, right? Pay as you earn doesn't come with that subsidy. Right, you're done with repayment sooner, but if your payment is lower than the monthly interest that accrues, your balance is going to grow. That also drives people crazy. Right, if you use SAVE, you will never see your balance grow again. Right, but SAVE also, this unpaid interest subsidy also means that if you make extra payments while you're receiving the subsidy, you're literally burning that money. Right, you're 100% wasting any additional payments that you make above your minimum payment using SAVE while receiving the unpaid interest subsidy. You would think that it might actually bypass the interest and hit the principal, but it doesn't work that way. If you make a payment above the minimum and it's lower than the interest that accrues, you're just reducing the amount of the subsidy. Right, so you never want to make payments more than the minimum when you're using SAVE, particularly when you're using that, when you're receiving that unpaid interest subsidy. All right, and now we can finally talk about the married question here. Right, so SAVE, which is an improvement upon REPAYE, allows you to exclude your spouse's income if you filed your most recent tax return separate from your spouse. Right, so coming back to that, AGI is the gold standard. Right, if that AGI is a married filing separate AGI, then your spouse's income can be excluded from the calculation. If, however, you file jointly, then you have to provide your spouse's income when you're calculating that monthly payment. Right? It often can make sense for you to file your taxes separately from your spouse if you have student debt and your spouse doesn't have any or doesn't have very much. Right? So you're going to have to weigh the cost-benefit analysis. You lose some tax filing benefits when you file your taxes separately, but you may more than make up for that in a lower monthly student loan payment. Right? It just depends on the dynamic in your household. The switching strategy that I alluded to before, right? So there's a time constraint on that, right? Which actually aligns itself very well with the internship specialty training timeline. Right? So if you're eligible for the new version of IBR, you can only execute that switch if you have fewer than 60 monthly payments in SAVE. Right? So 5 years. You have 5 years to use SAVE and benefit from that unpaid interest subsidy before you need to switch to the new version of IBR. Otherwise, you lose that opportunity. I see a question here. How is the percentage of the unpaid interest subsidy determined? So this is a change, wholesale change. It used to be 50% under revised pay as you earn. It was updated to 100% under SAVE. right? And anybody that was using REPAYE automatically got converted to SAVE, which means you automatically got upgraded to 100% unpaid interest subsidy. But this subsidy is only eligible for the SAVE repayment plan, right? So it went from 50% under REPAYE to 100% under the new version of SAVE. This was an interesting question that somebody asked as part of their registration. So the strategy with number of payments per month, is there a benefit to one monthly payment versus multiple? Again, this relates, this is why I put this one on this slide. This relates to whether or not you're receiving that unpaid interest subsidy, right? If you're using SAVE, you know, I can get where this person's coming from. Sometimes it can make sense for you to make multiple student loan payments, or multiple loan payments, not student loan payments, but multiple payments to a loan over the course of a month to accelerate that pay down, right? But your student loans don't act like other debt, right? So using strategies that might work with other debt often is very frustrating with federal student loans. I wouldn't recommend doing this, right? Make the minimum payment required by your income, right? Because if you're receiving any form of that unpaid interest subsidy, you're just going to end up wasting that additional payment if you're making it. Now, this becomes an issue because some employers are making payments towards student loans, which means they're wasting their money on your behalf when they're making extra payments to your loans while they're using SAVE and receiving that unpaid interest subsidy, right? So that's a really complicated and really fraught with frustration. So I would stay away from doing things like that. All right, so let's talk about this one-time count adjustment. So this is probably the biggest benefit that's lingering out there, and it's still there, right? But you're running out of time, right? So this is where we have to analyze our loans critically and look and see, do we have older loans that still have a balance and had some repayment time prior to starting to borrow for veterinary school? Right, so this really only applies to those of you that had any student loans from before veterinary school and had a break between when you finished that undergrad or whatever that program was and starting vet school and borrowing again, right? Because that's where you can take that older repayment time, consolidate it with your veterinary school loans, and increase your overall forgiveness eligible time. Right. So let's say, again, kind of that example I was using before where I had some undergrad loans. I had maybe a period of 5 years before I went to vet school. So my loans from undergrad were in repayment for a period of time, 5 years, let's say. Right. And then I started vet school and I've done an internship, residency. I'm done with that for a couple of years. Right. So that's 6 or 7 years plus the 5 that I was in repayment on my loans from before vet school. If I consolidate all of them together before the end of this year, I automatically increase my forgiveness eligible time to about 12 or 13 years, right? Which puts me closer to forgiveness, right? The closer you are to forgiveness, the less you're going to pay, right? And you're going to be done with your loan sooner, right? So look at your loans, right? Look and see if there was a break between when you took them, finished whatever program was associated with those loans, and then started borrowing again for veterinary school. Right? Forgiveness time is super valuable, right? Even if it's only a year, right? It's worth consolidating to increase that overall forgiveness eligible time, right? But you have to do that before the end of this year in order to be eligible for it. So back to that question about consolidation, right? There's never been a better time to consolidate because of this one-time forgiveness count adjustment, right? So if you've got those loans that aren't direct loans that don't qualify, consolidate them, right? Particularly for those FEL program loans, right? You have a repayment time, like if you have differing amounts of public service loan forgiveness time, which can happen, right? Particularly in those scenarios where you may have had a break between undergrad and vet school. If you consolidate them all together, you'll get that maximum credit for the oldest loan that was included in that consolidation. If you have loans with differing amounts of forgiveness time, consolidate them. This is more of any student, new grad, for most of you, unless you happen to be a student or almost new grad, this is more of a hindsight thing, or if you're helping to counsel some of these folks. But for students and very new grads, I see some of you, particularly those of you that do dual programs like PhD residency programs that have a school component with them, even though you're not borrowing additional student loans, you're still considered to be in school again. If you start those right after vet school, right? So if you graduate in May and start that program in August, during that next semester, essentially, if you don't consolidate those loans before you start that program, they can get stuck in another in-school status for the duration of that program, which can sometimes be 5, 6, 7, 8 years, right? And that sucks, right? So this is one of those things where you just kind of have to know, and we need to spread the word. And there's very few of our colleagues that do these, but when they do, it's very, very important that they get their loans into repayment after they graduate vet school and before they start this new program, so they avoid that in-school status for the duration of that additional training. And the only way to do that is to consolidate. They can end their grace period early and choose a repayment plan, right? So it's really imperative to help those folks figure that out before they start or enroll in that next program. Skip there. All right, IDR anniversary dates. So we already covered this, so this is kind of more of an overview. But nobody was required to renew unless your income decreased. Then you can submit additional information and have that payment lowered. But nobody should have to provide any additional information until at least March. But hopefully you'll see that anniversary date in your file when you upload it to the VIN Foundation My Student Loans tool, and you'll be able to add time to it until it gets beyond March 2024. There are some people that will have a very low payment into 2025, right? Just depending on when your anniversary date fell and how they're unwinding the forbearance benefits, you can have a really low or crazy beneficial payment all the way into 2025, right? And if that's the case, then congratulations. Okay, so we're going to work through some of these, and I'm going to, just kind of jump ahead and talk about how to use a simulator to input your information and see, and also some of the things that I'm seeing when people post on the message boards in terms of how they use the simulator that I'm trying to, educate people on, because they're leaving out some critical components, which can dramatically change which way you go, depending on how you choose to use it, right? So it's kind of it's a powerful tool, but you also, just like any calculator, right? The outputs are only as good as the inputs, right? So if you're not understanding the inputs, not only is that on me, right, but I want to show you how you can improve that so you can avoid some of those mistakes and maybe end up choosing a plan that's not that beneficial for you, right? So once you've uploaded this and you're comfortable with what you're seeing, we can send this information over to the loan repayment simulator, and it'll bring with it most of the information, the core information to get you started, right? So your graduation year, your principal, unpaid interest, the interest rate, overall average weighted average interest rate. This is where we need you guys to refine it, right? The repayment plan, unfortunately, we don't bring that over yet. Someday we're going to have that automatically come over with, but there's some issues there with doing that. But we know this person is using the pay-as-you-earn repayment plan, right? The years of repayment, also a big one, right? When they apply this forgiveness count adjustment in 2024, we're all going to be able to see how much official forgiveness eligible time we have. Just like the people who have been working towards public service loan forgiveness, right? They get to see how much public service loan forgiveness time they have. That doesn't exist for income-driven repayment yet, right? But that's part of that one-time forgiveness count adjustment. They're going back, they're looking through 43 million borrower files and assigning a number of years in repayment. And all of that years in repayment is going to be forgiveness eligible when it's applied in 2024, right? So this person we know graduated in 2017, right? So they have at least 6 years of repayment time, right? And you have to enter this years in repayment, right? This is really important, right? Because this sets how long we run the subsequent simulation for, right? And more people than not tend to either overlook this or just leave the default setting, which means we're starting your simulation from zero, presuming you don't have any forgiveness eligible time, which is not correct for anybody other than a veterinarian who only borrowed for vet school and just graduated, right? So years in repayment is nearly always going to be greater than zero unless you're a very, very new veterinarian, right? So make sure that you add those number of years in repayment. When you're in repayment, we haven't had to talk about this in a while, but if you use the auto pay feature, even if your minimum monthly payment is zero, you'll receive a 0.25% interest rate reduction, right? So what does that come out to here? So that's 5.41. So reduce that interest rate by 0.25% or subtract 0.25% from that. And then this is probably the hardest part, right? What is your income currently? What do you expect it to do going forward, right? So this particular person, right, has a $225,000 income, right? We're going to increase that annually by 3.5%. If you're paid on some kind of production scale, you can expect that to increase just because prices increase on a regular basis and you're paid a function of the services that you provide, right? Now, this person also has a very, very low payment for the next several months based on how they entered repayment. So I'm going to knock this down too to something very, very low, right? So let's assume that was based on their maybe last year of residency income, so we can make sure that we model that appropriately. Are you married? Yes, no, not yet. That will determine whether or not you need to add your spouse's income, how you file your recent taxes, whether or not your spouse has student debt, right? All of that will play a role in how your simulation pans out, right? I'm going to leave that out of there for now. Same with your kids, right? If you have kids now or you have other dependents that live with you and you financially support, they will factor into your family size, which will impact that discretionary income formula. For simulator settings, this is another area where I find people either just kind of blow through it or don't put anything in here. But if you do have a forgiveness savings plan, right, put the amount that you currently have saved that's dedicated toward forgiveness and the average annual return on that forgiveness fund that you're currently using, right? Because that will help to adjust the simulation as well and show you if you're on track with your forgiveness fund, right? So there's a lot of questions about how do I plan for the tax? Well, the first step is to get started, but after that is to check in. You know, how much do I have saved? How much time before I hit forgiveness? What am I earning on that forgiveness savings fund? All of that's going to determine how much you need to save going forward to hit your target. All right, so when we run this simulation out to the end, right, we can see that I've got about, it looks like I'm going to not reach forgiveness, but it's kind of close. So it really depends on what my income information does going forward. But either way, I'm going to keep making payments based on my income because they're going to be very low for a short period of time. And I probably didn't make that low enough, right? Because I know their payment is actually $67 a month under pay-as-you-earn, right? And then versus the alternative, which is closer to $2,100 a month, right? In this scenario, I don't hit forgiveness. And it's about the same cost as it would be using a standard 10-year plan payment, right? But I don't hit that standard 10-year plan payment for another 6 or 7 years, right? So I'm going to take advantage of that, make some payments that are less than that standard 10-year plan payment until my income gets closer to that, right? And then depending on how I'm doing with my financial planning, I might throw some more money at my student loans or look for other areas to invest those funds somewhere else. Now, let's say maybe this person, you know, takes a little bit of time off in between because they have a couple of kids and their income goes down during those years that they do, right? That might bring forgiveness back on the table, right? So let's decrease this income to something less. In those years that we have some kids, assuming that we don't live somewhere where you don't have some way of making up for that income that you might have while you're on leave, right? And here we see now we do reach forgiveness, right? Because we were really close before, right? So it's really sensitive to those particular inputs depending on what your income actually does. I mean, this is kind of a best guess, right? But you'll see as you continue earning, and if there's any interruptions in what you entered in there, right, it's going to favor forgiveness, right? So one of the ways I look at this is that it's very hard to plan for or to account for unexpected decreases in your income, right? And those tend to be very disruptive, right? So what the income-driven plans do is they provide insurance against those decreases to your income. If your income continues to increase for the entire duration of your career, congratulations, right? But those aren't generally problems, right? The problems I have there is, should I accelerate my payment so I pay it off in 12 years versus hitting forgiveness in 14 years, right? That's a luxury choice, right? But if I have a sick family member or something happens to me, or I have a sick child, or I take a longer than expected leave, or whatever the case is, where you have a decrease in your income for whatever reason, right? You don't have to worry about your student loans blowing up and causing you significant financial distress, right? So whether you hit forgiveness or you pay those loans to zero, right, either is fine, right? But if you are projected to reach forgiveness, let's have an idea of what that tax might be so I can plan for it, right? So I'm not caught off guard by that as well, right? So that's the just overall general recommendation when you're using the simulator. But you'll see that it's quite sensitive to your inputs, including family size and marital status, and how your adjusted gross income differs from your salary too, right? So I would also encourage people to put their adjusted gross income in here rather than their gross income, right? Because the Department of Education will always use that adjusted gross income, and your AGI tends to be lower than your gross income in most cases. Right, so spending some time with the inputs is really important. Ideally, and this really just kind of encompasses what I just said, right? That insurance, these two I can always get. These are the three most important things that I consider when I'm analyzing somebody's quote best strategy, right? So that's the most common question. What's the best strategy for me? Right? These are the most important two things. Right, which is the one that reduces the risk to myself and my family, which is the one that keeps my payment otherwise low enough that I have more income to use towards other areas of my financial wellness. Right, and then ideally, I'd like to pay the lowest amount possible. Right, but if I don't get this exactly, these two are still more valuable. Right, and this simulation bears that out. Right, this in the total projected cost here is actually slightly more than if I try to accelerate that student loan payment, right? But those other two, the reducing the risk to myself and my family and preserving my monthly cash flow, are more important. And I believe you'll be able to do other critical financial wellness things that will more than eclipse this $10,000 difference that we're talking about in an accelerated repayment plan versus a non-accelerated repayment plan. Right, and then let's say this person was working towards public service loan forgiveness instead, right? Let's say that they had logged already, 5 or 6 years in public service loan forgiveness. Maybe their income is a little bit less, right? Maybe they're not getting as much increase in their income, right? But that dramatically changes the total cost of the loan in the years that you have remaining in repayment. Right, because there were a lot of questions I saw you guys asking about public service loan forgiveness, and that's always a possibility for you guys, whether you're working towards it now or you might in the future. It's it's crazy to think about how beneficial public service loan forgiveness is here. Right, I've got $200,000 of student loans remaining. I might be paying $75,000 more on that, and the rest of it vanishes. And that's what the simulator really helps to differentiate. All right, let me come over to some of these questions. If I'm on pay as you earn, going for public service loan forgiveness, and 2% of my overall student debt was from undergrad, is it worth consolidating or better to just pay off the $8,000 separately? No, I would say that, well, first off, I don't know how far away you are from reaching public service loan forgiveness, but if it's not within the next 12 months, you're probably going to benefit from switching to SAVE. And if you can get the rest of that balance consolidated and eligible for public service loan forgiveness and keep them on the same time frame while adding those additional loans in there, then why not? Right? You're literally saving $8,000. If you asked me a week ago, after I finally got done fighting with my loan servicer, if it was worth $8,000 an out, I probably would have told you no. But again, $8,000 is not an insignificant amount of money. So it's literally, is that worth your time or not? And I mean, $8,000. I mean, I can think of a lot of cool things I would like to do with $8,000, right? So that to me, there's some pretty strong, compelling evidence to consolidate your loans under this special one-time forgiveness benefit that will allow you to preserve everything you have, but just add that $8,000 into that bucket of student loans that will ultimately be forgiven. If your spouse has a lower salary than you, have you found that filing separately still provides an overall benefit? Ooh, that's a good one. Here, let's go to the married bucket here. So it depends, right? And that one's really going to, and I saw a lot of you were from California, right? So that really depends on whether or not you live in a community property state, right? And two of the biggies, right? Two of the most populated states, California and Texas, are community property states, which means when you file your taxes separately, you have an additional layer of flexibility. It's more complicated, right? But in that scenario where your spouse earns less than you, maybe significantly less than you, the way that your taxes work when you file separately in a community property state, they pretty much take everything, put it in the same bucket, and half gets assigned to you and half gets assigned to your spouse. Right now, your spouse is going to have a tax return that has a way higher income than your spouse might be earning, but you're going to have an AGI that it has a way lower income than you're actually earning. And you can use that AGI to document your income for income-driven repayment plan, which makes it more likely that you'll reach forgiveness. Right? So if you live in a community property state, then the answer to that question is yes, absolutely. If you don't, then it depends. Then we would have to actually see the numbers to see if there is a significant payment difference. And you can see that in the simulator, right? If you run simulations and you add your spouse's income and you switch between jointly and separately, you'll see the differences in your monthly payment, right? So the magnitude of that income will play a role in determining whether or not that appreciably changes your monthly payment or if it just changes it very little. All right, I'm trying to understand the one-time count adjustment. I am in the exact scenario described. I have undergrad loans that took 5 years off before vet school. So will the count adjustment advance only my undergrad loans, or will it advance all my loans towards forgiveness? So it'll only advance all of your loans towards forgiveness if you consolidate, or if you have already consolidated them. Right now, I've been doing this for more than 10 years. And if you've attended any of these Climbing Mount Debt sessions in the past, I have encouraged every new graduate veterinarian to consolidate their loans after they graduate and apply for an income-driven repayment plan. If you've already done that, then you don't have to worry about consolidating again, right? But if your loans are not consolidated, right, that's part of the student loan physical exam, right? This person does not have any consolidated loans. They're all unconsolidated, right? When you see consolidated loans, you'll see direct consolidation in the name, right? If all of your loans are already consolidated, then you don't have to do anything but wait until the forgiveness count adjustment is applied. If you haven't consolidated your loans and that circumstance that you described is your case, then you should run to consolidate your loans before the end of this year, right? So, and you will do that on the student aid website under loan repayment, consolidate loans. right? So if you have not consolidated your loans and you've got a 5-year break between undergrad and vet school, you'll take that additional 5 years of payments on those undergrad loans, and you'll essentially impart that forgiveness time, that bonus forgiveness time, onto your veterinary school loans, but they have to all be consolidated together in order for you to get that benefit. Otherwise, your undergrad loans will receive 5 more years of forgiveness time. Your veterinary school loans will have 5 less. Right? The only way to get them to be in sync is to consolidate them. All right. Any other questions as we kind of wind this down? And you guys, there'll be some ones here that we haven't had a chance to click through yet. But these are some of the most common mishaps I see, right? Assuming an income-driven plan or public service won't work for you, right? Because you read something on the internet that said that these plans don't work, right? It's just not true, right? It is, they're not set it and forget it. There's no doubt about that. But a little knowledge goes a long way. It can save you tens, if not hundreds of thousands of dollars. Consolidation procrastination, just based on the flood of questions that Rebecca and I have received as the pandemic forbearance benefit has winded down, I know there are going to be people that wake up on January 1st and start asking us questions about the one-time forgiveness count adjustment, right? Don't be that person, right? You cannot wait. I mean, that is like the most crazy beneficial thing that has ever come about in student loans, right? You know, outside of them just wholesale wiping out student loans, which the Supreme Court wouldn't allow, this one-time forgiveness count adjustment is the next best thing, right? If you have any forgiveness time that you can gain by consolidating before the end of this year, do it, right? This is a crazy limited time benefit that likely won't come down the pike again. Right. So don't be that person that asks us that question on January 1st of 2024, because it's going to be really hard to say no. Right. Sorry, you missed the window. Right. So get on that sooner rather than later. The clock is ticking. It's, you know, we're bearing down in November already.
Yeah, I'm just sitting here like nodding along, Tony, as you said that, because I mean, we've seen over the last couple of weeks and months, just people who are benefiting like crazy by consolidating and putting themselves in line to receive the full benefit of that one-time forgiveness count adjustment. So especially those of you that had time in repayment before vet school or anything like that, definitely look into that.
Absolutely. And the parallel to that is the payments. I don't even really talk about that anymore. But anybody that made payments during the forbearance benefit period could request a refund of those payments. And we're still getting questions now, but like, oh, can I still request a refund of my payments? And it's like, yep. Probably not. You probably missed that window, right? So, and that sucks, because that was another huge opportunity that you know, just kind of went by the wayside because, you know, the head was in the sand for a little bit too long. I mean, I get it. Everybody's busy, and you guys, you know, probably busier than most. But you know, this is stuff that it kind of falls into that personal well-being category, right? You got to take care of yourself before you can take care of others, and these are some of those things that hopefully, you know, you can act on sooner rather than later.
And it really just does speak to that. Like, it's not a set it and forget it thing for your student loan repayment. Like pay attention, you know, kind of understand what's going on. And if you have questions, that's what we're here for, right? Like, we're always, you know, Tony does a great job with like the blog post, and we'll do podcasts and really try to break these things down and make it more comprehensible, because we do understand like you're super busy and you have a lot of going on, and maybe you don't necessarily understand this stuff. Totally get it, but ask those questions and stay in touch with VIN Foundation so we can let you know what's going on.
This one I highlighted in red. This again, kind of getting a rare do-over, but still the reflex reaction in the advanced training medical communities, right? Not just veterinary medicine, is to defer your loans while you're doing internships and residencies. And that's a no-no, right? Use an income-driven repayment plan, right? Particularly save while you're doing those advanced training. And that's going to have to come from you guys, right? So a lot of you either already have made that mistake and learned the hard way, or you got kind of this rare do-over because you did it while the pandemic forbearance benefits were in place, and you're going to still get credit for that forgiveness time anyway, right? But for the people that are just starting their internships and residencies now, if they put their loans in deferment, they're not going to get credit. They're not going to get forgiveness time for that. right? So they have to keep their loans in a plan like SAVE, where the government will cover all of that interest, right? Deferment, why deferment sucks is the interest still accrues, and when you end the deferment, it adds to your principal. So whether you end up hitting forgiveness or you end up paying your loans to zero, you end up paying more than you had to, right? So that's where SAVE is hugely beneficial, right? SAVE actually turns the interest off while you're doing your residency, just like it did for the pandemic forbearance benefit, right? So for those of you that are in a position to talk to those interns and residents about not deferring their loans, please do that, right? Because that's going to save them thousands and thousands of dollars of interest. All right. Regarding consolidation, you just apply on the federal student aid website. Any other details we should know? Let's see. So you'll log in and you'll walk through the consolidation process. It's going to ask you to choose a loan servicer. Now, all of the loan servicers suck. It just is. But choose Mohila, right? Not because they're good, but because they monitor public service loan forgiveness progress, right? So which means they have to be more familiar with the income-driven plans. And if you ever are or currently are working towards public service loan forgiveness, your loans are going to end up with Mohila anyway. So you might as well reduce the number of times that your loans get moved around and just choose them during the consolidation process. During the consolidation process, they will also ask you, do you want, how do you want to pay your student loans, right? And that's where you're going to apply for a plan. Right now, if you're already using an income-driven plan, right, it's kind of like you're starting over again, right? So you're going to choose the plan that's best for you, whether that's the plan that you're currently using or the plan that you want to use when your loans are consolidated, but you're going to have to provide updated income information. That's either going to be your tax return that you filed most recently or a current pay stub if that's less than what your prior tax return shows. There's going to be a lot of language. They added a lot of language about opting in and automatically pulling your tax return information. And, it takes a long time to wade through that. I mean, honestly, if you're getting bogged down in that, just check the yes box, and you can undo it later if you don't like how that's working. But the goal is to get your loans consolidated, or at least get the consolidation application submitted before the end of the year, right? But you do want to leave yourself some time, right? It's not uncommon for that consolidation loan to kind of get hung up, right? And if you need to correct something, you still want to have the opportunity of getting that consolidation loan application submitted before the end of the year, particularly if you can benefit from that count adjustment. So yeah, start it with studentaid.gov. And I think that's about the only other things that
the other thing I would mention is the language about it, just because it does not reflect that one-time forgiveness count adjustment. That's been something we see on the boards a lot.
Yeah, it'll tell you that your clock is going to get reset, right? And unfortunately, that was the case before, right? And the one-time count adjustment language supersedes that, right? So this is a special exception that even in the case of consolidation, you're not going to reset your forgiveness clock. You will temporarily, but then the count adjustment is going to assign you a qualifying repayment count that's in line with the number of years those loans in repayment had. And whatever the maximum repayment count is going to be the count you receive on your consolidation loan. Cool. Any other questions? Those are some really good ones. There's a lot of stuff that we didn't get a chance to click through, but you guys have access to this. These are just kind of my non-negotiables. Please start a budget, right? You can't manage what you don't measure. The majority of you aren't measuring, right? So that really helps when it comes to figuring out these other critical financial wellness items, all of which supersede paying extra towards your student loans, right? A good emergency fund, paying off less flexible debt, saving for the down payment on a home or a practice opportunity, expanding your family. All of these things are imminently doable and easier to do, and will outweigh the benefits of paying off your student loans faster, right? So you guys are kind of in the driver's seat there, just based on your specialties and the earnings that are associated with those. But make sure you're prioritizing these other items, right? Before getting bogged down in your student loans. Manage them appropriately, and if you're going to hit forgiveness, plan for it, right? But these other items are way more important than your student loans. And there are, as we covered ad nauseum today, there are lots of opportunities for you to receive that forgiveness on those loans, even with those higher incomes that often come with a majority of your specialties. Any other questions that we may have missed? Cool. Well, thanks everyone. You're a very interactive group. I appreciate that. And if you have any other questions or you have in need of any additional assistance, please feel free to reach out. And if you want to post in the student debt message board area so you can have your questions answered, we can certainly address them there as well. Just know that we've got a little bit of a backlog, so we're still, it's usually a few days before we get replies, and at current check we're about 6 weeks behind. So it's it's been taking a while to get through all the questions that have come through, but we're learning a ton from those experiences that you guys are having, and we're helping you navigate those challenges as payments have gotten restarted. But yeah, there's a wealth of information in that student debt message board area. So if you have kind of immediate questions or things, you may want to peruse those discussions and see if you can answer those questions that way, because it may be a while before we can take that in-depth dive into your student loans and get you a detailed response.
And as a reminder to everybody, you will be getting a follow-up email tomorrow from studentdebt@vinfoundation.org. And in there will be a link for how you can get your CE credit. And the CE certificate for those that attended live will be coming from Jordan@vinfoundation.org. So keep a lookout for all of that. And a big thanks to Tony for your time and effort, and to Becca for helping on the back end as well. And we hope to see you all in another webinar soon. Thanks, everyone.
Thank you. Thanks, everyone.